The day the Fed saved Bear Stearns. The first battle of the 2008 financial crisis. March 2008 was the moment the global financial crisis stopped being a problem for Wall Street and became a problem for the entire world. For months, the cracks had been spreading through America's financial system. Mortgage defaults were rising, complex securities were collapsing in value, and confidence between banks were evaporating. Yet, despite these warning signs, many believed that the largest investment banks were simply too powerful, too sophisticated, and too interconnected to fail. That illusion shattered when Bear Stearns, one of the oldest and most respected investment banks on Wall Street, found itself on the edge of bankruptcy almost overnight. Clients rushed to withdraw their money. Trading partners refused to lend. Credit markets froze. Within days, a firm that had survived the Great Depression and countless financial shocks were running out of cash. Faced with a decision that would shape the future of the global economy, the Federal Reserve confronted a dilemma unlike anything it had seen in generations. Allow one of America's largest investment banks to collapse and risk a financial panic, or intervene in a way that critics argued rewarded reckless risk taking. The decision the Fed made over one dramatic weekend would become one of the most controversial rescues in modern financial history. It would save Bear Stearns from immediate collapse, redefine the government's role in financial markets, and ultimately set the stage for even greater turmoil just 6 months later, when Lehman Brothers would not receive the same treatment. The story of Bear Stearns is not simply about one investment bank. It is about confidence, fear, liquidity, and the realization that in modern finance, perception can destroy institutions long before insolvency does. In this episode, we examine how Bear Stearns reached the brink of collapse, why the Federal Reserve chose to intervene, and how this unprecedented rescue changed the course of 2008 financial crisis. Bear Stearns before the collapse. For decades, Bear Stearns represented the aggressive culture of Wall Street. Founded in 1923, the firm earned a reputation for risk-taking that more conservative banks avoided. While rivals focused on traditional investment banking, Bear Stearns expanded aggressively into mortgage-backed securities, derivatives, and structured finance. During the housing boom of the early 2000s, those markets generated extraordinary profits, and Bear Stearns became one of their biggest participants. This strategy appeared brilliant. While home prices kept rising, banks packed thousands of mortgages into securities and sold them to investors around the world. Credit rating agencies assigned many of these securities high ratings, convincing pension funds, insurance companies, and foreign governments that they were buying relatively safe investments. Bear Stearns not only traded these securities but also financed them using enormous amounts of borrowed money. High leverage became the firm's greatest vulnerability. Like many investment banks at that time, Bear Stearns borrowed heavily in short-term funding markets, particularly through repurchase agreements or repos. Every day, it needed lenders willing to roll over billions of dollars in financing. As long as confidence remained high, this system worked efficiently. But if lenders began questioning the firm's financial health, that funding could disappear almost instantly. The warning signs emerged in 2007 when two Bear Stearns hedge funds heavily invested in subprime mortgage securities collapsed spectacularly. Investors lost billions, and confidence in the firm's mortgage business began to erode. Although Bear Stearns insisted that the damage was contained, markets had started to question the true value of mortgage-related assets held throughout the financial system. By early 2008, Bear Stearns still reported billions of dollars in capital and claimed it remained solvent. Yet in modern banking, solvency alone is not enough. A financial institution also requires liquidity, the ability to obtain cash whenever counterparties demand it. As rumors spread across Wall Street, Bear Stearns was about to discover that even a profitable balance sheet could not survive a complete loss of market confidence. The bank run that happened without depositors. Unlike traditional commercial banks, Bear Stearns didn't rely on ordinary customer deposits. There were no longer lines of anxious families outside its office demanding cash. Instead, the panic unfolded behind computer screens and trading terminals, where hedge funds, investment firms, money market funds, and global banks quietly began pulling their money away. Every morning, Bear Stearns depended on billions of dollars in short-term financing to keep its operations running. These lenders assumed the firm would remain financially sound for another day and agreed to renew their loans continuously. But in the second week of March 2008, that confidence evaporated. Counterparties refused to roll over funding. Clearing clients transferred their assets elsewhere. Prime brokerage customers moved billions of dollars of rival institutions within hours. Bear Stearns faced a liquidity crisis unlike anything in its history. What made the situation so dangerous was that this was not unnecessarily a crisis of insolvency, it was a crisis of confidence. The firm's assets still had value, but they could not be sold quickly enough to generate cash needed to meet immediate obligations. In modern finance, a bank can fail not because it is bankrupt on paper, but because it runs out of time. Executives at Bear Stearns scrambled to reassure investors and trading partners that the firm remained healthy. Public statements insisted that liquidity was strong and that rumors of distress was false. Instead of calming the markets, those assurances had the opposite effect. Every denial fueled further speculation that the situation was even worse than the public knew. By Thursday, March 13th, the crisis had become existential. Bear Stearns no longer had enough cash to continue normal operations. Without emergency assistance, one of Wall Street's largest investment banks was only hours away from collapse. The decision now shifted from the firm's executives to the highest levels of the Federal Reserve and the US Treasury, where officials were forced to determine whether saving Bear Stearns were necessary to protect the entire financial system or whether allowing it to fail was a risk the economy could withstand. The weekend that changed Wall Street. As Bear Stearns raced towards collapse, officials at the Federal Reserve and the US Treasury worked through one of the most intense weekends in modern financial history. Time had effectively run out. If financial markets opened on Monday without a solution, Bear Stearns would almost certainly default on its obligations. The consequences could spread far beyond a single investment bank. The Federal Reserve feared that Bear Stearns was deeply interconnected with nearly every major financial institution in the world through derivatives, repurchase agreements, and prime mortgage services. Thousands of counterparties relied on the firms every day. A disorderly bankruptcy could force those counterparties to absorb sudden losses, trigger panic across credit markets, and create a chain reaction that threatened the stability of the global financial system. The challenge was that the Federal Reserve could not simply write a check to Bear Stearns under its existing framework. Instead, its officials turned to JPMorgan Chase, one of the country's strongest banks, acting as an intermediary. JPMorgan agreed to provide emergency financing backed by the Federal Reserve while negotiations for a permanent solution continued. This temporary lifeline brought only a matter of days. Behind closed doors, government officials pressured potential buyers to acquire Bear Stearns before markets reopened. Most institutions refused. The risks were enormous, and no bank wanted to inherit billions of dollars in uncertain, mortgage-rated assets. JPMorgan Chase remained the only realistic option capable of completing a rescue quickly enough to prevent immediate panic. After marathon negotiations lasting through the weekend, a deal was reached. JPMorgan Chase would acquire Bear Stearns, while the Financial Reserve agreed to finance up to $29 billion of the firm's most illiquid asset through a specially created vehicle known as the Maiden Lane LLC, by removing the riskiest asset from the transaction. The Fed made the acquisition financially possible. When financial markets opened, Bear Stearns still existed, but only because one of the most extraordinary government-backed rescue operations. When financial markets opened on Monday morning, Bear Stearns still existed, but only because of one of the most extraordinary government-backed rescue operations in American financial history had been completed over a single weekend. The immediate crisis had been contained, but the rescue also raised a new and uncomfortable question. If one investment bank had been saved because it was considered too interconnected to fail, what would happen when the next institution reached the brink? The $2 deal that shocked the world. When the details of the rescue became public, Wall Street was stunned. JPMorgan Chase had agreed to purchase Bear Stearns for just $2 per share, valuing the entire investment bank at roughly $236 million. Only a year earlier, Bear Stearns stock had traded over $170 per share, giving the company a market value of more than $20 billion. In less than 12 months, one of Wall Street's most prestigious firms had lost all of its value. For Bear Stearns employees, the announcement was devastating. Thousands of accumulated company stocks over the years, believing the firm's success would secure their financial future. Senior executives who once held fortunes on paper saw their wealth evaporate almost overnight. Careers built over decades ended in a single weekend, illustrating how quickly confidence can disappear in highly leveraged financial institutions. The initial acquisition price also triggered outrage among shareholders. Many argued that even under severe distress, far Bear Stearns was worth far more than $2 per share. Facing intense resistance and the possibility that shareholders could reject the agreement, JPMorgan renegotiated the terms. The purchase price was increased to $10 per share, raising the value of the deal, but still representing a collapse of more than 90% from the company's peak. The Federal Reserve's role became equally controversial. Critics argued that by financing 29 billion of Bear Stearns' troubled assets, the government had effectively transferred private sector risk onto public balance sheet. If those assets continued to lose value, taxpayers could ultimately bear the losses. Supporters countered that the intervention was designed to stabilize the financial system rather than rescue Bear Stearns, shareholders who had already suffered catastrophic losses. The rescue achieved its immediate objective. Markets calmed, fears of an instant financial meltdown subsided, yet the operation also established a dangerous precedent. Investors began to believe that if another major investment bank collapsed, the Federal Reserve would intervene again. That assumption would profoundly influence market expectations during the months ahead, and it would be put to the ultimate test when an even larger institution, Lehman Brothers, stood on the edge of failure. The moral hazard debate. The rescue of Bear Stearns immediately ignited one of the fiercest debates in modern finance. Had the Federal Reserve prevented a catastrophic financial collapse, or had it rewarded years of excessive risk taking? Economists, politicians, bankers, and investors were deeply divided, and the argument continues to this day. Those who defended the rescue argued that the crisis was no longer about Bear Stearns alone. The firm sat at the center of a vast web of financial contracts connecting banks, hedge funds, pension funds, and institutions around the world. A disorderly failure could have frozen credit markets, triggered panic selling, and spread losses throughout the global financial system. In this view, the Fed was protecting the economy, not Bear Stearns. Critics saw the situation differently. They argued that the investment bank had spent years earning enormous profits by taking aggressive risks during the housing boom. Executives and shareholders benefited when those bets succeeded. If the government stepped in whenever those bets failed, financial institutions would have little incentives to manage risk responsibly. This problem became known as moral hazard, the expectation that someone else will absorb the consequences of a reckless behavior. The Federal Reserve attempted to strike a balance. It didn't save Bear Stearns as an independent company. Shareholders suffered massive losses, executives lost control of the firm, and thousands of employees faced an uncertain future. At the same time, the Fed prevented a disorderly bankruptcy that it believed could destabilize the broader financial system. The message was mixed. Investors could lose heavily, but the system itself would be protected if necessary. Markets drew their own conclusions. Many participants came to believe that any large interconnected financial institution would receive similar support if it approached failure. The expectation temporarily restored confidence, but it also created a dangerous assumption. When another investment bank, largely more indebted and under even greater pressure, began to unravel 6 months later, investors expected another rescue. Instead, the US government made a dramatically different decision, one that would send shockwaves through every major financial market on earth. Bear Stearns' legacy and the road to Lehman Brothers. The rescue of Bear Stearns marked the beginning of a new phase in the financial crisis. But it didn't resolve the underlying problems. The toxic mortgage securities that had destabilized Bear Stearns were still sitting on the balance sheet of banks across the United States and around the world. Housing prices continued to fall, mortgage defaults continued to rise, and confidence within the financial system remained fragile. In the months following the rescue, policymakers hoped that stabilizing Bear Stearns would buy enough time for markets to recover. Instead, conditions deteriorated further. Investment banks found it increasingly difficult to raise capital. Lenders became more cautious, and investors scrutinized the financial health of every major institution. The crisis had evolved from concerns about one firm's liquidity into doubts about the solvency of the entire banking sector. The Bear Stearns rescue also changed how markets viewed the Federal Reserve. Investors now believed that the government could intervene whenever a systematically important institution approached collapse. This expectation temporarily reassured financial markets, but it also created a dependency on government support. Every rumor surrounding a major bank was now accompanied by a single question: would Washington step in again? That question became unavoidable in September 2008 when Lehman Brothers found itself facing a liquidity crisis remarkably similar to Bear Stearns. Once again, counterparties withdrew funding, confidence disappeared, and bankruptcy loomed. Yet, this time, the outcome would be entirely different. Policymakers concluded that no viable private buyer could be found and chose not to provide the same level of support that had been extended 6 months earlier. The bankruptcy of Lehman Brothers unleashed a level of panic that exceeds the fears surrounding Bear Stearns. Credit market, global credit markets froze, stock markets plunged, money market funds came under pressure, and governments across the world were forced to launch unprecedented rescue measures. Whether the decision to save Bear Stearns made Lehman's failure more shocking or whether Bear's rescue simply delayed an inevitable reckoning remains one of the most defining questions of the 2008 financial crisis. The fall of Bear Stearns demonstrated a fundamental reality of modern finance. Institutions built over decades can collapse within days if confidence disappears. It also revealed that in a highly interconnected financial system, the failure of a single major institution can threaten the stability of the global economy, forcing governments to make choices where every option carries enormous consequences. Conclusion: the collapse of Bear Stearns was more than the downfall of a single investment bank. It exposed structural weaknesses that had been building inside the global financial system for years. Excessive leverage, dependency on short term funding, opaque financial products, and the disbelief that housing prices could only rise had created a system that appeared strong on the surface but was extraordinarily fragile underneath. The Federal Reserve's decision to support the rescue through JPMorgan Chase prevented an immediate financial panic in 2008. In the short term, the intervention succeeded. Markets stabilized, counterparties avoided a disorderly collapse, and policymakers gained valuable time. But the rescue could not eliminate the underlying losses embedded throughout the banking system. It postponed the crisis rather than ending it. The events surrounding Bear Stearns also transformed financial regulation. In the years that followed, governments imposed stricter capital requirements, increased stress testing, strengthened liquidity rules, and expanded oversight of systematically important financial institutions. Central banks around the world re-examined how they would respond when major financial firms face sudden liquidity crises. Even today, the Bear Stearns rescue remains a defining case study for economists, regulators, and investors. Some argue it was essential intervention that prevented an immediate economic catastrophe. Others believe it encouraged expectations of future bailouts and distorted market discipline. The debate continues because there is no perfect answer when financial instability and market accountability collide. What is beyond dispute is that the weekend of March 2008 changed the course of financial history. It marked the moment governments accepted that the failure of a single interconnected institution could threaten the entire global economy. It was the first major rescue of the financial crisis. It opened the opening chapter of an unprecedented era of government intervention and a warning that the worst was still to come. Just 6 months later, the collapse of Lehman Brothers would push the world into the deepest financial crisis since the Great Depression, proving that saving Bear Stearns had been only the beginning of a much larger storm.